Good evening, everyone. My name is Abdul Waheed, and I'm the president of AKUAANA University Alumni Association North America. So I welcome you all on behalf of AKUAANA to our webinar series, which is meant to be inform and educate all of our alumni and bring them together. So this is our first of the series this year. And thank you for joining us here. Tonight we have Syed Nishat and Dr. Faisal Qureshi. Dr. Faisal Qureshi is going to be hosting a conversation and dialogue with Syed Nishat, who's our expert speaker tonight. We will learn about tax and estate planning, and I'm looking forward to learn quite a bit about the two topics. Among physicians, many a time, we don't get to pay a lot of attention to topics related to finance and management of day-to-day things and future goals. So looking forward to learning a lot. Our speaker, Syed Nishat, is a partner at Wall Street Alliance Group, and he is knowledgeable and has been invited speaker at a lot of different forums. He has published a number of articles about asset protection and common financial mistakes by physicians in Medscape and medical economics. He is regularly quoted and interviewed in media outlets like Forbes, US News, Bloomberg, and Yahoo Finance. Thank you, Syed, for joining us and agreeing to come and educate us tonight. And then Dr. Faisal Qureshi is going to basically host for remainder of the time to ask some questions and sort of lead the discussion. And you all know Dr. Faisal Qureshi is past president of AKUAANA, and one of the actually founding members of AKUAANA, and our organization has learned a lot from him. He's a pediatric surgeon by profession, and currently based at UT Southwestern Medical Center as associate professor of pediatric surgery and director of bariatric surgical center at Children's Medical Center in Dallas. There's a lot I could say about Dr. Qureshi and his achievements, but tonight I would also let you know that he is a Master in Business Administration, which is something I learned recently. So without any further delay, I'm going to ask Dr. Qureshi and hand it over to him.
Thank you.
Two more things I forgot is I would ask you to use the question and answer Q&A section freely and post your questions there. And as the dialogue goes further and the discussion moves ahead, I would be looking at the Q&A and will be posing your questions to both of our experts. Okay, over to you, Dr. Qureshi.
Thanks for that wonderful introduction, and congratulations on becoming the president of AKUAANA. Folks, welcome tonight. Syed is going to be talking to us a lot about the things that he's an expert at. By design, we've made this webinar very scripted. What does that mean? I've got questions. He's going to answer them. He's going to go into a lot of points. They're not going to be very detailed on purpose because there's a lot of things going on that we as physicians should know. The second thing is, obviously use the chat, reach out to Syed, but if you want to reach out to your financial advisor, please do. Whatever you learn here is meant to help you make some good decisions. Again, put your questions in the Q&A section, and then we've divided this webinar into separate areas, and you'll see where we'll pause at different sections and review your questions. And then hopefully we'll have about 10 minutes at the end for an open Q&A. With that, let's get started. Syed, welcome. Thank you so much for agreeing to do this. We're looking forward to your talk, and I know you've got a wonderful talk and a screen that you're going to share with us. So welcome, Syed.
Thank you. Thank you very much, Dr. Waheed, for arranging it, and for the AKUAANA graduates, and actually for you open up for pretty much everyone. Really, really appreciate it. And thank you, Dr. Qureshi, for volunteering and doing this pro bono, taking time from your family for doing it, this educational webinar. So we really appreciate it, and I'm looking forward to have a successful webinar.
All right, fantastic, Syed. So why don't you go ahead and start sharing your screen? And as he's setting this up, as I said, it's going to be a scripted webinar a little bit. You know, one of the big things that physicians and everybody worries about, especially if it's now at the end of February, tax season is around the corner. Can you tell us some things that are changing or are going to change over the next couple of years for tax planning and what we should be worried about?
Yeah, so as you mentioned, Dr. Qureshi, tax planning is extremely important for physicians. Last year, we know that Biden administration proposed almost a $3 trillion infrastructure bill. Whenever you have a huge infrastructure bill like this, usually in the economy, there's a budget deficit. And a lot of time people ask the question, what's the best way to fix the budget deficit? And the easy answer is by raising the taxes. And obviously the Biden administration, and if you take a look at Bernie Sanders and Kamala Harris, one thing for sure they're talking about is increasing the overall taxes. Now, there are a lot of consensus out there about the bill, but overall, the feeling is if the income is more than $400,000, you'll be affected the most. And it's not uncommon for physicians to have income more than $400,000. But just to give you an idea, what are some of the things that are in the bill? If you see my screen, if your income is more than $400,000, tax rate goes up from 37% to about close to 39%. You might think, okay, it's about 3% jump. What's the big deal? The issue is that any income more than $400,000, currently, any W-2 income you take, after 140, approximately, you don't pay any Social Security tax. The bill is saying any income more than $400,000, you have to pay additional 12.4% Social Security tax. It's because the Social Security is running out of money. So obviously, it's important to have your income down close to 400,000 so you don't get affected that much. And lastly, small businesses, they have itemized deduction like car expenses, mileage expenses, etc. So just in case if the individual business expenses have income more than $400,000, the itemized deductions start to phase out. So that's why it's very important that one thing for sure, the tax is going to go up effective 2022, most likely retroactively. It's important you sit down with your own financial advisor, CPA, and see what are the tax deduction vehicle available, strategies available. So when it becomes effective, the high tax rate, your overall tax burden doesn't go up too much.
Thanks, Syed. So, with that in mind, I'm about to file my taxes in another month. What are some important deductions that we should be looking at as the year starts, as the tax date comes around?
Yeah, so obviously we are talking about the year 2021. Right now, this is February of 2022. So most of the plans should have been done actually last year. So one thing what we could do right now before April to make sure that you don't miss out any deduction. What I mean by deduction is when you file for the taxes, there's some deduction that you can claim it. Now, there are two types of deduction when you file for the taxes, either use TurboTax or any company you use. One is called standard deduction, one is called itemized deduction. Standard deduction, basically IRS doubled it for the last few years. Double means it doubles from 12,000 to right now almost close to 25,000 joint merit files. So that means you don't have to show any deduction, it's a standard deduction. The problem is most CPA is taking an easy route and filing a standard deduction. But hey, you have an option to itemize the deduction if you want to. So it's a good idea to sit down and see your bills, a bunch of some donations if you have done last year, see if you have some interest, see if you have some mortgage payments or other deductions. You can put it together and show it to the CPA so you can go over the 25,000 threshold we are talking about. Now, just to give you an idea, some of the deductions, according to our experience, we see when we review the tax return, physician miss. Since 2018, there's a deduction passed, it's called QBI, Qualified Business Income Deduction. This is for self-employed physician, mainly I'm talking about. So any self-employed physician, any income they derived, you can write off 20% of the income as a deduction. So for example, if you're doing locum, 1099 income beside hospital, if you're collecting $100,000, 20% of $100,000, 20,000 you can write off just as a deduction. A lot of times people say, I'm a physician, I don't qualify. No. If your income is below $315,000, everyone qualifies. Understand that. So speak to your CPA if your below income is $315,000, if you qualify for QBI, for self-employment income. Number two, there's a QBI or qualified business income deduction for rental income as well. So for example, it's not uncommon for physicians to have rental properties, condos in New York or all areas. And if you collect a rental property, you can write off 20% of the rent as a deduction. So let's say the rent is $50,000 per year, 20% of $50,000 is $10,000 you can write off as a deduction. Again, speak to your CPA if you qualify for QBI for rental properties as well. The fourth one, in the screen, if you see it, before April 15th, or depending on your tax filing deadline, sometimes you can take extension as well. You can open a SEP IRA if you're self-employed. In a SEP IRA, you can contribute $58,000 or 25% of your adjusted gross income, whichever is less, just to give you an idea. You can actually do a cash balance plan if you're self-employed. In a cash balance plan, just to give you an idea, if you're at the age of 60, you can contribute almost $260,000 pre-tax, and this money is all tax write-off for you. Straightforward IRA account, husband, wife together over the age of 50 can contribute $7,000 each. And HSA account. So HSA account, I see Dr. Qureshi physician miss all the time. Like they work for the hospital, they're themselves physician, they never actually go to physician checkup, they actually treat themselves. HSA is a high deductible savings account for health saving plan. So husband, wife together for the family, you can contribute $8,100 pre-tax money before April 15, and this money is tax write-off as well. And the beauty of HSA account after the age of 65, you can use it for non-health reason as well. So again, these are all pre-tax available. Sit down with your CPA and see which retirement account is applicable for you. For the year 2021, we are talking about though. Then we're talking about some more deduction, student loan payments like new graduates or fresh graduates, AKUANA, we see all the time they have student debts. If your income is below 140,000, you can write off $2,500 approximately the interest you pay for the student loans. Then if you have a rental income coming in, if you have done any improvement or if you have depreciation, speak to your CPA to write off the depreciation from the rental income you're collecting. It's a full write-off for you, but we see people miss it all the time. Last year, because of COVID, Omicron as well, Delta as well, a lot of physicians changed their practice working from home. If that is the case, a percentage of the amount that you spend at home for the business, depending on the square footage, you can write off some home office deduction as well. Again, speak to your CPA if you qualify for it. R&D credit. So usually this is my dentist clients, they actually get it. So R&D is called research and experimental tax credit. If you have basically invest into some equipments or into a process where it can actually help your client, or it is a research phase, or you have bought a product that overall customer service experience goes up, R&D tax credit is also available. The maximum is $250,000. So usually we see the dentist client, we get it all the time. So speak to CPA if you qualify for the R&D tax credit or not. And last year is the only year the food expenses is 100% deductible. Usually it's a 50% of the money you write off. You must spend money on food, but last year, the only year, 100% you can write off. And lastly, this is for senior citizens. If you have did any home improvements for home health care, or some states like California, if you have did some improvement like renewable energy, you can get some write-off and expenses as well. So I know that it's a long answer to a short question you ask, and there's a lot of lists we're talking about, but this could be a good framework to use and speak to your CPA which one is applicable for you, so you don't miss out any important deductions.
Thanks, Syed. Just for the audience, this is being recorded. A link will be sent out to you, so you guys will actually have access to all this information. Syed, I'm going to ask you a question about the food expenses, and you'll only talk about people who have business-related food expenses.
Correct.
Does that apply even if you're a W-2 employee?
No. So if you're just a W-2, it's not going to work. You need to have some businesses to write this off for.
Correct. Thank you. So now that this is for 2021, can you tell us what we should be doing for 2022? How do we plan a little bit better moving forward?
Yeah. So for 2022, I think it's a good opportunity because a lot of things you can do. And ideally, what we do, we sit down with the CPA at the beginning of the year, at the end of the year. So do some planning so that we don't miss out anything. So a good starting point will be for physicians who work for the hospital to max out their 401k or 457 plan or 409A plan. In a 401k plan for the year 2022, you can contribute over the age of 50, almost $22,000. All money is pre-tax. And a lot of times when you contribute into a 401k or 403b plan, there's a match. So at least contribute how much is the employer is matching. Typical, the match is 6%. At least contribute that much. 457 plan is a deferred plan. You can still contribute 22,000 if you're over the age of 50, but there's no match. 409A plan, a lot of physicians miss out, depending on the hospital. In a 409A plan, you can contribute almost about 80%, as much as high of your W-2. All money is pre-tax. The problem is in a 409A plan and 457 plan, if the hospital filed for bankruptcy, the money is not 100% safe. So that's why we're not saying that put a lot of money into it, but if your income is very high, you can speak to your CPA if it's applicable for you. Now, self-employed physician, I spoke about for 2021 do it, but for 2022, you can set up the cash balance plan as well. Cash balance plan is a defined benefit plan. It depends on wage and age. As I mentioned, if someone is 60 years old, you can contribute almost $260,000 self-employed physician, and this money is all tax write-off. But if it needs to be adjusted by the W-2 if you're self-employed. So if your W-2 is low, contribution is low. But all of this needs to be fixed by December. So that's why it's better to do it ahead of time. Now, this one law I want to speak about, it is called SALT, S-A-L-T. When Trump became the president, the state taxes and also the property taxes you pay, the cap is only $10,000. Previously, we used to write off the state taxes, we pay the property taxes, we pay the mortgage, we pay all of this. But SALT came in, the maximum write-off is only $10,000. The law changed. Since last year, a lot of states adopted a rule that if you have a corporation, your own corporation, the state taxes that is due, if you pay from the corporation, you can get to write off from the federal level. So for example, New York City, my Wall Street Alliance Group, let's say the company makes $1 million. 7% is the state tax rate. It's a 70,000 taxes due. I cannot write off 70,000. How much maximum I can write off? Only 10,000. But if I pay the 70,000 from the corporation, I can get to write off the full amount. So, but it's not automatic though. You have to choose it on that particular year that elected to pay from the corporation. Like New York, you have to choose it from by March that for 2022 you want to pay it. So that's why I speak to a CPA that, hey, I want to pay the state tax from the corporation. Please make it applicable for me. And more states are adopting it. New York, New Jersey, Maryland, and a lot of states. And lastly, I want to talk about the Roth conversion. One of the Biden's proposal is the Roth conversion is going away. Like so far, if you have an IRA account, you have the option to convert it into a Roth IRA. There's no income restriction in it. But if the income is more than 400,000, one of the proposed bill is the Roth IRA conversion is going away. Now, this year may be a good year to do it, and I put it there because the market for the last few weeks, we all see has been down substantially. And we all know that in an IRA account, when you take the money out, you do have to pay some taxes regardless, right? You're just deferring the taxes. But if you convert the Roth IRA now, if the 401k is down right now, the overall taxes will be low. But once you convert it, Roth IRA, the money grows tax-free, and the withdrawal is also tax-free after the age of 60. So again, the whole idea is the Roth conversion when the market is down, and this year is a good year to do it. And lastly, this is also, again, a self-employment physician that if you think there's a need that you want to hire your own kids, depending on the state you live in, you are giving them some funds probably anyway to pay their pocket bill. But hiring your children under your corporation, you're making them work summertime and pay them $6,000. They understand the value of money. They're working as well. But the beauty is that since they have earned income $6,000, they can open up a Roth IRA for themselves. And then this money will grow tax-free. And then after the age of 5 years, they can use the money for actually qualified expenses as well. They don't have to wait until 60. So I think that these are a few of the ideas that are there from a retirement point of view for the year 2022.
So that's actually fantastic. I've learned quite a bit. Waheed, are there any questions that we can answer at this time?
Yes, we have a couple of questions related to tax year 2022 and planning. And both questions are pretty much related. First one is understanding this figure of 400,000. Is that for individual income or household income?
It's a household income.
Household income. Okay. Second one is related is, so the 12.4%, which is additional, is that anything above 400K, or is that on all of your income, inclusive of 400K, the one below 400K?
Yeah, so this is the proposal, and hopefully it's not going to pass. So any income more than 400,000, only that portion you pay 12.4.
Wonderful. Thank you.
Great. Waheed, I don't think I see any more questions, so we're going to keep moving.
Sure.
Now, Syed, we spent a lot of time talking about retirement accounts. Are there any other vehicles that we could use for 2022?
Yeah, so beside retirement, from a business perspective, I'm talking about, this is nothing to do with self-employment. So physicians who are on W-2 employee, they also invest into real estate. So if you invest into real estate, we're recommending try to invest into opportunity zone. That's become popular for the last few years. In opportunity zone, what is opportunity zone? It's an area where there's a 20% property rate. In opportunity zone, if you invest into it, and if you hold the property for 10 years, there's no capital gain tax. It's very powerful. So that's why if you invest into real estate, ask your realtor, does it qualify for opportunity zone? New York is hard to find it, but New Jersey, we see it, Texas, we see it, depending on the suburb you live in. So the government wants the rural area to actually grow. So opportunity zone is very popular for real estate investment. Car deduction. Typically, Dr. Qureshi, that when you buy a car under a corporation, there's a limit how much you can deduct. The tax law becomes very favorable. If the car weigh more than 6,000 pounds, you can write the full purchase price of the car from the business as an expense. It's called accelerated depreciation. So let's say you buy a GMC, a kind of truck, a bigger car or family, you can buy it, and car is $80,000. Because of the accelerated depreciation, you can write off the whole $80,000 as a business expense. But most likely it will go away. It's still there. Use it for 2022. 5 to 9 contribution. So depending on the state you live in, for example, New York, $10,000 per child I can contribute, and I can get the state tax write-off as well. So again, 5 to 9 contribution before December, you can contribute and get some state tax deduction. Now, tax harvesting, what I meant by that a lot of stocks I'm talking about for the last few weeks we saw went down a lot, and you may have some profit into some stocks. Whenever you sell a stock, at one point you do have to pay taxes regardless. So I'm just giving an example. Hypothetically, you have Visa, a stock is down, you're losing money. You can sell Visa, take a loss, but you can buy something similar like MasterCard, and the stock goes back up. Hopefully you took a loss, and this loss you can carry forward to offset the other income you may have it. So again, tax harvesting, you have the full year to do it. Try to do some tax harvesting if it's possible. And then again, I want to get into real estate because I see physicians do it all the time. So in a real estate, in US, in residential US estate, there's a depreciation. Depreciation means the property every year becomes older, right? So it's a depreciate the property. Residential is a 29-year depreciation. Commercial is a 39-year depreciation. So what means the depreciation amount you collect, the rental income you collect, you can get a write-off. It's a wash-off. Cost segregation is a study that 39 years depreciation, you can bring it down to 5 years. So you get a lot of depreciation, you can get write off all the income you have it. So we just did a client of ours who's have a surgical center, bought it for $1 million. We did a cost segregation, we get a $250,000 advanced depreciation. So in a 35% tax rate, we're talking about $87,000 tax savings. So any rental income the client collect, you pay no taxes up to $250,000. So it's very powerful. If you are big into real estate, speak to your CPA about cost segregation for 2022, if it makes sense or not. And lastly, I will touch bases about charitable contribution. This is not the scope of today's presentation, but one, I see that physicians always give cash as a donation. But if you are an investor, if you bought stock and the stock is profitable, try to donate the stock. Because when you sell the stock, you have to pay taxes regardless. So for example, you bought Apple as $100, stock is $150. You want to donate anyway. What you do, just take Apple and donate it. Difference is going to be from 100 to 150, you pay no taxes, plus you get a deduction as well. You can contribute 30% of your adjusted gross income as a stock, as a donation if you want to. And you can create donor funds. And a lot of people who are religious, they pay zakat, they invest in synagogue or a mosque or AQ endowment fund as well. So if you want to do it, a donor fund is a good way of doing it, is giving appreciated stock. But if you have more interest, we can talk one-on-one and sit your financial advisor, see if it makes sense for you.
Thanks, Syed. Waheed, I see one question in the chat and 3 in the Q&A.
Yes, I think we have several of those. So I'm going to look at the one in the chat is about, is it worth paying taxes for your children and getting them Roth benefit? Asking for opinion.
Yeah, so I guess the question is that that the Roth benefit for the children to contribute for the Roth IRA for the children, if that's what it's asking, or should they do pre-tax for the children? Most likely that's what the question is. But for the children, they're in a lower tax bracket. So you should do Roth IRA versus a pre-tax, is because the money grows. Later on, the child will be in a high tax bracket, most likely when it grows. So Roth IRA does make sense. And the beauty is, Dr. Waheed, that the child, when he buy the first home, up to $10,000, he can take it out without paying any penalty from a Roth IRA. At one point, a child will buy a house. So I think it's very powerful. If it's possible to do a Roth IRA, the child doesn't have to work for your company. If it works for, let's say, for example, a school part-time, or let's say a celebrity, child celebrity and earning money, contributing to Roth.
Excellent. Then we have a question actually about cost segregation for real estate. Is it for both residential and commercial real estate?
Yeah, it could be both residential and both commercial. But what I meant by residential, it needs to be used for business. You cannot do it for primary house. So if you use a residential and then you're renting it out, then it becomes for commercial use. But it's zoning as residential. But yes, so definitely it needs to be for business purpose, not for primary house. You can do a cost segregation.
And similar related question is, what options are there for rental properties abroad, outside US?
Yeah, outside US is a question we see it all the time, that if I'm collecting income, what do I do at that time? I mean, since 2014, it is required, though, you have to at least declare it, the properties you have it in your tax return. You don't not necessarily have to pay taxes. But if you're collecting the rental income there for some reason, depending on the country you have treaty with, like India, you do have to pay taxes, all right, the NRI taxes. But in Pakistan, I think they have a treaty, they can leave the money there. But once you bring the money over here, you do have to pay taxes if you haven't paid the taxes there. So depending on the country you live in, but yes, there's no cost segregation, nothing can be done. Some taxes are due, but right now the law is any property you own, you have to just declare it in your taxes.
Now, I also have a generic question, which I don't know if you want to answer now, or it's a little bit related, but maybe at the end of the session, I'm going to read it. And how much money do you need to retire? Like asking like generic opinion. There is 4% rule. And if you have 10 million, you draw 400,000. It will last you for 30 years. What is your opinion?
Yeah, so basically, sorry.
Do you want to tackle this after the estate planning section?
We can.
Yeah, I think we'll move on, although I just see another question related to deductions, Waheed.
Yeah, it says, can you please summarize all the possible deductions for W-2 employees with no other income?
Yeah, for W-2 income, as I mentioned, unfortunately for a W-2, the best way to get the deduction is through your employer, because all you're collecting is W-2. So 401k, 457, 409a, max out as much as you can for the deduction purpose. And then the mortgage expenses, you can get to write off all of it. But then if you invest into some other properties, make sure that you have all the receipts, get the deductions as much as you can. But unfortunately, if it's all W-2, if it's all academic, we are heavily relying on the retirement plan the employer offer.
And donations, right? And charity.
And the donations and charity, definitely those are there.
All right, fantastic. It's 7:30, says, so I'm going to move us along because I know there's, as I said earlier, there's a lot of information. You can reach out to Syed or your accountant or your financial advisor for more details. Let's talk about estate planning. Why do you always push this? Why?
Yeah, estate planning, I think, is really the foundation when it comes to financial planning. And I think from a personal experience, 2 years ago, one of my best clients passed away, pulmonologist passed away due to COVID. And I cannot emphasize for this client is not having a will and trust. Just to give you an idea, if this client did not have a will or a trust, something as simple as the custody of the children would be decided by the US government in US. In Pakistan and other countries, there are laws out there that can guidance. Over here, the court decide what's going to happen. And for this client, I'm giving an example. It's not like this tomorrow, if my client died, the court comes and just give the money to property to the family. Here we go. The way the process was a lengthy process. So you have to take the will, copy of the will, or if there's no will, you have to go to court. And there's a process, the court release the fund. This process is called probate. Depending on the state you live in, at the South, the probate is as long as 9 months. But you can avoid all of this by creating a simple basic will, simple basic trust. And physicians, they are, due to pandemic, we know it's a high-risk job, and it's very important to actually have at least the basic will and trust, which is part of the estate planning and health proxy and power of attorney done as soon as possible. That's the very must, that's the least they should do.
All right, fantastic. And you don't have slides for this section, I don't think.
No.
What are the top estate planning mistakes that somebody like me can avoid?
Yeah, so when I see the estate planning mistakes, so we're talking about you created estate planning. Now, what the mistakes I see it? The number one mistakes we see all the time is that when you create a will and trust, you created a trust, you created a will, but you actually have to title it. What I mean by that, like you say, created, for example, Syed Nishat Trust. If I have a house, the house should be moved under the name of Syed Nishat Trust. If I have a bank account, it must be moved under the name of a Syed Nishat Trust. If I have a retirement account, the beneficiary, secondary beneficiary must be Syed Nishat Trust. If I don't move it and created all this paperwork, it is just collecting dust in your closet. So if you die, it still goes to probate process. So make sure once you create all these documents, move everything under the name of and title it properly, number one. Number two, mistakes I see it, that if anything happens to the parents, the way the trust is written, it goes outright to the name of the children. What I mean by that, if anything happens to me, my son inherits everything directly under his name. Think logically, tomorrow my son grows older and gets married, get into a divorce or lawsuit, the estates become half. So that's why the best way to do it is create the trust in such a way, if anything happens to you, the children is forced to create their own trust and then move the money. So in this way, a divorce happen, a lawsuit happen, all the assets are protected. So these are basically the two major mistakes we see when we create the estate planning.
That's fantastic. That's a little scary. You mentioned a will, a healthcare proxy, a trust. Is there anything else, I mean, that we should be thinking about?
Yeah, so basically most of the times we see physician, depending on which state they live in, they just have a basic will and that's it. They usually go to a mosque and say, hey, I went to mosque before Hajj, I did my will. Okay. So nothing else I see it. And the will are very basic. If anything happens, this is what's going to distribute. I think, as I mentioned, if you have a will, if anything happens to you and your family, what needs to happen that your family have to take the copy of the will, send it to court. The court have to authenticate it. This authentication process takes almost 3 months, to some state 9 months. So that's why will itself is not enough. You have to have a revocable trust as well. Revocable trust is a private document. If anything happens to you, nothing goes to court, everything transferred to your children under the trust the next day. So beside will, make sure you have a trust as well. And the second thing, you need to make sure you have a power of attorney as well. That's something I saw when my clients become sick. The wife had the power of attorney. So she was able to call us and run the business how she wants to. So make sure that you have a power of attorney as well. That's extremely important.
Fantastic. Let's pause here, see if there's any questions.
Yes, I do have a couple of audience questions. The first one is like, how much is the role of the state? Which state you're living, and when you're making the trust and the will, and is there any consideration for state laws?
Yes, state has a major role to play. I mean, depending on the state live in. For example, in New Jersey, New York, the probate is becoming easy day by day. But if you live in, for example, Kentucky or Kansas, or even Texas, I'm talking about, depending on the county you live in, it's not just like, the state itself, it's the county you live in, how backlog are there. That's the issue it becomes. They do have a major role to play. So the worst thing, what you don't want to do is go through the hassle of going to the county or the clerk whatsoever. So if you just have a house, a retirement account, and that's the end of the story, maybe you'll be fine. But if you're a physician, most likely you will have a large sum when you retire. You're in a high income bracket. So that's why it's very important to organize all of this. So you actually don't have to deal with the state, because the state has a major role to play if anything happens to both of you.
Yeah, so it seems like there's another question which you might have just answered, and I'm just going to ask it just to clarify, is once you have a will, you would be transferring your house and all your assets under the trust. You would transfer your house and your assets to the trust, correct?
Correct. Yes, you have to fund it as well. So it's not like that that you're not funding it, but there's some rules into it. For example, Texas, you're not going to move it under the name of the trust, because Texas, as long as it's joint, Texas as a home state exemption is very powerful though. So I don't want to put the trust into it. Florida, the same way, I don't want to trust into it. I'll just keep it into the joint. But the other assets, we have to figure out something to avoid the probate process. So depending on the state as well. So that's why we are giving you the punchlines, but it's very important to sit down with your own CPA and financial advisor. Your circumstances might be different to see which state you live in.
Now, there is a similar question to the one before, real estate outside of US. And if there is a family-owned land outside, especially India, how can we transfer the sale of that, or maybe inheritance if the land comes in inheritance to someone here in the US with least tax consequences?
All right. So if we're talking about India here or Pakistan here. So just keep in mind that inheritance, if you inherit any money in America or outside of America, if the estate is more than 22 million, the question is 22 million, only then there's the estate taxes due that you do have to worry about paying, right? But if the estate is below that, you inherit it, you don't have to most likely worry about this. But once you sell the property outside of the United States, there might be taxes that's due over there. You do have to pay. So what I would do is once the assets are getting sold, I will speak with the attorney over there. I will speak with the laws over there and see if their taxes due over there, and then I'll transfer it. Because any money more than 5,000, you transfer it back here. Bank will ask the question where you get the money from.
Yeah, and inheritance or transfer of that to the next generation. I would imagine you would need to consult an attorney within India too. If
correct. The main thing is to worry about the laws over there. For example, London. It's not as simple. You take this money out from England. It's not that simple. There's taxes going to be due over there. So far, the understanding is, so state is country-wise, that law you must follow it.
Thank you.
I think, Kuwait, there's a couple more questions in the Q&A now.
Yes, I see that. There's one says, please repeat recommendation about child named in revocable trust and needs a trust, also in case he gets divorced before while funds are distributed.
Yeah, so what I'm trying to explain that that the revocable trust should be drafted in such a way, if anything happens to husband, wife, parents, the children should not take money under their own hand in their own brokerage account. Because if the son gets or daughter gets married, it's very easy to commingle the money with the spouse. I would do it. I mean, how can you tell your wife, I don't want to commingle my money with you? So and then get into a divorce, the money at that time is up for divorce decree. What's the best way to avoid it? So you put the clauses in the trust, on your own trust. If anything happens to you, the children is forced to create their own trust under their name and transfer the money. So in this way, the money is not part of commingled with the spouse. It's going to be a separate account must be open, separate fund needs to be there. So any divorce happen, any lawsuit happen, the assets are protected.
Now, the another question is, so as you transfer your primary residence or write it into the trust, is there any closing cost or any other expenses which are involved?
Yeah, so revocable trust, it is basically just a shell, it's just a name, it's under your social security, nothing changes. All you're just doing is avoiding process, probate. So there's no cost to it. All you have to do is to the county you live in, just send it to the deed of trust that it is under the, so for example, Syed Nishat, if I own a property in Texas, I'll just send it to the county I live in, change the title to Syed Nishat Family Trust. So, but there's no tax consequences, there's no cost to it to do that. For revocable trust, but irrevocable trust, those are in a different, we have to sit down and talk in more detail. There's some tax consequences, filing, cost involved into it.
There are 3 or 4 other questions. I think I'm going to wait for those towards the end. They're more sort of generic than estate planning. So,
all right, let's switch gears, Syed. Let's talk about asset protection. Why is asset protection important for me as I get older? Why is that so critical?
Right. So asset protection is very important for physician. There's a statistic done by American Medical Association, 60% of physicians over the age of 50 get lawsuit at least once. And the statistic is quite higher for certain profession like OBGYN and surgeon. So I think it's very important for physician to get some sort of asset protection beside the malpractice insurance they have it. So just in case if they get lawsuit, it's not covered by the malpractice, all their assets are protected. And there are different strategies out there the physician can implement it so that can give you the peace of mind because they are in a high risk job profession.
So just protect yourself. It's bound to happen at some point in time. And then what are the simple asset protection strategies that I can employ today without spending a ton of money?
Yeah, so the starting point would be a lot of physicians think that asset protection is very costly. It's not the case though, and the states are becoming, depending on the state you live in, it is becoming very friendly in terms of making some rules and regulation that give you the asset protection. For example, Pennsylvania, they have something called, if you own the house under individual name, the house is not protected. But the same house, if you own it under joint tenants in entirety, it's a type of title. Or bank account, if you're not just a joint account, joint tenants in entirety. I'm talking about a state, I use an example. If a lawsuit happens, it's a very strong protection and there's no cost to it. All you have to do is just change the title. Another option could be if your spouse is non-physician, just give more asset under her name. So in this way, if a lawsuit happened, most likely it will come under a physician's name. As long as the assets are under your wife's name separately, the assets are protected. If you own real estate beside the primary house, is another mistake we see, don't have it under personal name. It must be a different LLC. So if a tenant break the head or get into an accident, as long as under a separate LLC, the assets are protected. Again, for Texas, I'm giving an example, it's cost about a few $100s. Doesn't cost that much to create an LLC and give you the asset protection. And most of the times we, 401k, IRA, annuities, 5 to 9 plans have elements of asset protection. That's why regardless of asset protection, you should try to invest through this vehicle. So you control these assets. But meanwhile, if a lawsuit happens, the assets have elements of asset protection. And lastly, you can think about an umbrella policy. Umbrella policy, the problem is if a professional liability doesn't cover it as a physician. But if you get into, let's say, for example, car accident, if someone get into an accident in a lawn, the umbrella policy covers the insurance as well. It's very cheap. The company who does your mortgage, State Farm, Geico, Allstate, you can get it very cheap. Usually 2 to 3 million we recommend for physician client. You should get some umbrella policy as well. But after doing all of this very low cost asset protection strategies, if the assets are big enough, we would like to see more than 5 million assets. Then you can think about domestic asset protection trust, Nevada trust, FLP. These are expensive, few $1,000 costs. You can sit down with your financial advisor one-on-one and get these situated if you want to.
That's fantastic. So it sounds like a personal trust, umbrella policy, LLC, and then maximize all your retirement funds because those are protected.
Correct.
Does that sound about right? Okay.
Correct.
Fantastic. All right, Waheed, you're back on. If you want to get through some questions. Waheed, if you're talking,
now there is a question about which goes back to the trust again, and that's what are the major differences between revocable and irrevocable trust?
Yeah, so far we are basically talking about a revocable trust to avoid the probate I'm talking about. But you can actually create something called an irrevocable trust as well. Revocable trust means that you can change the provisions in a trust any given day, anytime, without any consequences. Irrevocable trust basically means that once you create the trust, the provisions cannot be changed. The benefit of irrevocable trust, whatever assets you put into the irrevocable trust, all of them are protected because it's irrevocable. No one can change it. So depending on your state, you can create an irrevocable trust. Once you create an irrevocable trust, you have to lose all the control. You have to gift it, whatever you put in. For example, you have a daughter or a son. You want to protect an asset, primary house, $5 million, for example. I want to protect it, put into irrevocable trust. You lose all the control. Nothing can be changed. It belongs to the children. As long as you cannot control it, it's irrevocable, it gives you asset protection. But the whole idea of irrevocable trust is asset protection, and it cannot be changeable.
A similar question is like if property is under revocable trust and for some reason it's sold in your lifetime, what happens?
Yeah, so revocable trust, as I mentioned, there's no tax consequences. It is under your Social Security. You can just buy and sell anytime under the name of the trust. There's no issue whatsoever. Imagine this way that it is under your name. You want to sell the property, buy the property, no problem.
There is another question which is about basically kind of the umbrella policy and the trust. Like if an injury on the property happens, can they go after the trust?
Yeah, so revocable trust, as I mentioned, it is no asset protection there. It's just a probate protection. So if an injury happened, claim may happen. And so that's why you have few million umbrella policy to cover it.
I see. And if one has rental property, so should each rental property be under a separate LLC?
Yeah, so depending on the state you live in, so nowadays is becoming common. Like for example, Texas, I'm giving an example. You don't have to have multiple LLC. Texas allow called LLC series. You can create one LLC. Under that LLC, you can create LLC 1, LLC 2, LLC 3. Very easy to set this up. So if you have multiple properties, one LLC under umbrella, you can have multiple series of LLCs. So in this way, it's become very cost effective. A lot of states are adopting this policy, depending on state you live in. But ideally, each property should be under a separate LLC, because if two properties under one LLC, one lawsuit all open. So that's why, as long as the property value more than 250,000, we would like to see each property separate LLC.
Now, I'm not sure if I understand the question correctly, but I'm going to read it the way it is written. Do you still get property tax deduction against W-2 income if your house is in a trust?
Property tax deduction. So yes, so you get the same deduction as imagine it is under your name. Nothing changes. So a property tax. But remember the property tax and then the state tax, the maximum is $10,000. So depending on the tax you live in, so state you live in. So, but yeah, you will get up to $10,000 deduction that's needed. That doesn't change.
Yeah, I have another question. If we have a second, going back to property outside. So I understand that the taxes are due and local laws apply when inheritance is consolidated in Pakistan or India. But when the money is transferred to US, are there tax implications again from US laws? Basically, do you owe the US government money to? I remember you mentioning a large sum of number. Could you go over that again, please?
Right. So as I mentioned that that if you inherit the money, anything if the estate is more than 22 million that you inherited, only then the estate tax is due. Now, one thing to remember, let's say you didn't inherit it, you just didn't buy and sell. That's why the declaration was needed. In the declaration, you mentioned what is your cost when you bought the property outside of the United States. When you're selling it, they will do the comparison, what price you sold it, the cost, the difference you owe some taxes. Income tax may be due, but the estate tax should not be there.
I see. One specific question is, does Florida have LLC series? Specifically Florida?
Yeah, so Florida, adopted the LLC series, but so far I know Texas has it and more states, Illinois has it, and Florida, I think it's a matter of time they will have it.
Thank you, Syed. Thank you, Wade. So gentlemen, since you guys are the owners of this webinar series, it's now 8:51 Eastern. We still have 3 or 4 more questions. Syed, I see we have some section on Secure Act and other areas. Do you want to keep going with the questions, or do you want to look at some of these other questions that we had talked about?
I can very quickly just talk about the estate taxes and Secure Act very quickly.
Okay.
Quick hits, maybe.
Yep. So
just get started, yeah.
Yeah, just a couple of things to just explain that, we're all talking about income tax here, but the estate tax, I think I already covered it. If US, if husband, wife both dies, if the net worth is more than 22 million, only then 50% taxes are due. That's about to go down. In 2025, it's becoming only 11 million. Husband, wife both dies, more than 11 million, there's estate taxes due. So something should be done about the state taxes, regardless the law change or not, because it's about to change in 2025. Now, what are some of the solutions we can do about this? You can create, like I mentioned, the word irrevocable trust. You can gift it right now, 22 million. This is out of your state if you want to. You can, every year you can gift $15,000 per child. So husband, wife together can give $30,000 giveaway to children as a gift, no gift tax due, and this money is out of your state. You can buy a second to die life insurance policy if you want to, and then husband, wife both dies, the life insurance can pay for it. And lastly, charitable remainder trust. Again, this is not a cover, something we'll cover it today, but if you're charity minded, you can, if anything happens to you, the money goes to charity. And from there, you can withdraw income as well. So if your net worth is more than 15-20 million, you can think about the charitable remainder trust as well. But the bottom line is the estate taxes is changing from 22 million. It's about to come down to 11 million in a couple of years. Speak to your financial advisor to do some estate tax planning.
Did you want to talk about Secure Act?
Yeah, so Secure Act, one quickly, I think is applicable for physician, and this is already law. It's not about to change, it's already changed. So Secure Act is setting up for the whole community of a retirement enact. That's the law that passed in 2020. So before Secure Act, what happened that if anything happens to you, your retirement account, I'm talking about, your children inherited, the children basically has the whole life to slowly take the money out. So that means, let's say I die, my son who is, let's say 21, from 21 to life expectancy, slowly take the money out. All right, it's called stretching the IRA. That's going away. So if anything happens to me now, whatever the IRA account my son who's 21 years old basically inherit, it needs to exhaust it or use the money within 10 years. You can say, hey, what's the big deal? The big deal is that there's a huge amount of tax that is due. So again, Secure Act is already a law. Just to give you an idea, an example, if you have a $5 million before Secure Act, the child, if my inherited, had the whole life to slowly inherit the money, but now due to Secure Act, if my child inherit the money 5 million, $500,000 every year or 5 million at the end of 10 years, my child has to exhaust it. So the law is already there. Make sure you speak to your financial advisor. If your retirement account is substantial enough, what can be done about Secure Act?
So currently I have a question, if you allow me, is When one gives money to grown children, is it taxable to them?
Yeah. So as I mentioned, there's no taxable. Up to 22 million, you can just give it to the children. There's no state tax. There's no gift tax. Nothing is due without giving any gift tax to the children. But so the children, getting the money from the parents, no tax is due. But obviously, whenever buy sell happen from the day they inherited, there's an income tax due. But in the inheritance or in the gifting, up to 22 million, there's no taxes due.
Thank you.
All right. Now, just to conclude, the Secure Act, I spoke about few of the solution a physician can do. One option could be do a Roth conversion I spoke about, because what happened, the Roth IRA is also subject to Secure Act. 10 years you have to exhaust it, but there's no taxes due. This is one option. One option could be that you spend more money during retirement from an IRA account and leave the Roth IRA for children. That could be the option number 3. Third option, give the money to the grandchildren if you want to. Grandchildren, what happened, the Secure Act doesn't kick in until the child is over the age of 19. So one option could be give it to the grandchildren if you want to. You can buy life insurance that can pay for it. So these are some of the solutions available out there, but again, these are very advanced topic. Depending on your situation, we would like to see the retirement account size more than 5 million to do this kind of planning. But it is there. It is going to affect most physicians regardless, because we need about 6 million. Like the question you ask, I think, how much money do you need to retire comfortably? The number is 6 million. So without 6 million, it would be hard to retire in US comfortably. So that's why the money will be there. So the question is, what's the best way to handle it? Could be combination of either or. So, but it's important that you speak to your financial advisor, which one is applicable for you.
Fantastic, Syed. That was fantastic. Waheed, if you don't mind, I think there's 2 questions here that we need to really answer. One is, if you have a 401k, should you retire in state with no state income tax so that you get maximum benefit?
Yeah. So the question is basically, I hear the question all the time, like, people, that's why Florida is a retiree state, is because there's no state taxes. But just make sure you're happy in life, not like, what, you left all your friends and staying in Florida and staying alone, right? You have to be happy. So as long as you're happy, not just all about money, you have friends and relatives, have a good quality of life, because that's cost as well. It's absolutely fine.
So as a follow-up, somebody recommended to me that, or talked about, right before I retire as a surgeon, I should go become a school teacher so that my last year's income tax rate goes down. What do you think of that strategy?
Yeah, even actually, I have clients who wants to retire very sooner, so their overall income taxes goes down if they want to. Yes, as long as you're happy, that's the question, and as long as you have enough money to retire comfortably, absolutely. And that's what the financial planning is important. That it may not be needed that you have to work until 60. Some clients retire at the age of 55, and they're very happy. So that's why, behavioral financial planning come in. It's not just always about money, it's coaching about the lifestyle and quality of life, because life is very fragile. So make sure at the end that have a quality life as well, not always about money.
And then as a segue to that, Ali's asked, what factors do you look into while picking a financial advisor? Sometimes they can be quite expensive if they charge a percentage of asset under management.
Yeah, so a financial advisor, one thing I would just caution, all physicians or anywhere, if you're thinking you're going to use a financial advisor to make you a lot of money, you're making a big mistake. Financial advisor, they will not be able to beat S&P. The reason you use a financial advisor because you do not have time, number one, and you don't have time to do everything yourself. Like I have a client who knows more than I know in terms of investment. So, in this situation, why the client should be paying the 1% fee to do all of this? You're using a financial advisor to do the estate planning, asset protection, college planning, all of this under very umbrella very efficiently. And when you choose a financial advisor, make sure the financial advisor is a fiduciary. All right. The word fiduciary is very important. Like you are a physician, you're a fiduciary. You do the best thing of the patient's overall situation that then get advice. A fiduciary advisor, this is his or her legal responsibility to act the best interest, and make sure that the financial advisor provide other service beside investment, like estate planning, college planning, put everything under one umbrella. And usually the fiduciary advisor charge a percentage of fee, like 1% typically we see charges. But again, the question you have to ask, is it worth it for you to pay all of this? If it's not, do it yourself, I recommend. And then maybe just hire an attorney by yourself, but there's a lot of information online, you probably can do it yourself. So the question to do it is, if you have time to do it yourself, we recommend do it yourself.
Excellent. We can probably, spend quite a lot more time on questions and discussion can go on, but it's top of the hour at 9, and as promised, we're going to close down. Everyone, if you have further questions, more than welcome to reach out to your personal financial advisor or to Syed Nishat. Just last couple of things I didn't say more clearly, and although they were mentioned by Dr. Qureshi already and Syed Nishat, that all of this discussion is meant to be educational and not personal financial advice. And so please reach out to your personal financial advisor for specific advice in your circumstances. And lastly, I wanted to thank both of our, our guest speakers, Syed Nishat, and our host, Dr. Qureshi, and my executive counsel, my secretary, Dr. Faisal, our treasurer, Abdul Waheed Khan, and immediate past president, Dr. Faisal Chima, for their help in arranging all of this. And we look forward to meeting you all in our next webinar. So thank you so much. Have a good evening.
Thank you again for inviting us. And thank you again, Dr. Qureshi, for doing what you're doing.
Thank you.
Thank you. Bye-bye.
Bye-bye.